I'm Jessica Amir, market strategist at Moomoo, and I'm proudly today joined by S&P Dow Jones Indices head of US investment strategy, Anu Ganti. Anu, thanks for joining us from the US.
Absolutely. It's so great to be here, Jessica.
So today we're talking about ETF trends and where to next. So let's kick off. So what stood out to you, Anu, in terms of investment trends last year?
Yeah, so 2023 was a fascinating year, and all around the world, we saw a lot of different themes, but particularly if you look at the US, the outperformance of mega caps was a powerful theme. And just to give you an example, our S&P 500 top 50 index was up 38%, outpacing the S&P 500's return of 26%. So that was a big trend that was going on. Now, diving deeper at sectors, we saw that information technology, communication services, consumer discretionary were the big performers in 2023. So strong reversal from what we saw in 2022. And these weren't just any three sectors. These were the three big sectors. So that was a very interesting theme to watch. Also, towards the end of last year, we started to see a broadening out of the rally towards mid and small caps, which was interesting. And now coming to the fixed income side, because of the pullback in treasury yields, we saw gains across our fixed income indices as well. So to sum up, it was really an everything rally across asset classes.
Yeah, absolutely. And really important to also highlight that I guess some of that outperformance, a lot of the bigger gains were in sectors that typically do well when rates are being cut. So in terms of, I guess, surprises, did anything really surprise you last year, Anu?
It's a great question. And I think one thing that surprised me is if you look at dispersion or cross-sectional volatility, which we frequently look at to assess active manager conditions, looking at Australia, for example, we saw that dispersion came down at the stock level, the sector level, and at the country level. So what that tells us is it really indicated fewer opportunities to add value from active outperformance. So that was one interesting surprise. Another is just coming back to Australia, is we saw very similar themes that we saw in the US. Again, the outperformance of the mega caps with the ASX 50 outperforming the ASX mid-small. We also saw a reversal in sectors. Information technology and consumer discretionary were the outperformers, big reversal from the prior year. So it was interesting to see the dynamic of the US versus Australia and those consistent themes that we saw picked up.
Yeah, consistent themes again. So moving to, I guess, how much we're seeing index funds or ETFs have exposure to the US markets. We caught up with the former head of S&P Dow Jones Indices in 2019, Craig Lazzara, and he said that 25% of the US market was held by index funds or ETFs. What does that look like today, Anu?
Yes, so we continue to track the evolution of indexing. And today we estimate that roughly 25 to 35% of the US market is held in passive. So what that tells us is plenty of opportunity for future growth. And there's a couple of reasons that are driving this growth. Number one is low cost. And at S&P, we estimate that investors have saved roughly $28 billion in 2022 across the S&P 500, 400, and 600. So that's an important statistic to keep in mind. Another trend is just the professionalization of the industry. So if you go back to the 1970s, that was a big turning point when institutional investors came to dominate the market, and generating alpha became that much harder. And now if you fast forward to today, the game has gotten harder as well if you think about all the new advances in technology. So those are two important trends that are driving the growth of indexing.
Absolutely. And saving fees is particularly important for a lot of investors. So with that said, how else can investors benefit from, I guess, buying or holding ETFs that mirror, say, the S&P 500 or the ASX 200 versus stock picking? What's the benefit?
Yes. So, we talked about a couple of the points, right, which is low cost and professionalization. Another important point is diversification. And this is closely tied to a concept called skewness. And we measure this all around the world. And what we see is that most equity markets are positively skewed. And what that tells us is that outperformance tends to be driven by a few winners, a few stocks. So it really makes the case for diversification, owning more stocks, and just having luck on your side. And we see this in Australia, we see this in the US, we see this all around the world, which is pretty powerful.
Powerful indeed. Speaking of, I guess, force, we do know that the Federal Reserve is expected to cut interest rates this year. That's according to, I guess, their speaking and thinking, and also the Fed Fund futures are pricing in rate cuts as well. How do ETFs or index strategies compare to the rest of the market in times of Fed rate cuts?
Yes, no, it's definitely fascinating to watch the macro climate and the market response to it. At S&P, we use our SPIVA scorecards, which stand for S&P Indices versus Active, where we measure active performance versus their respective benchmarks. And again, we started this in the US more than 20 years ago, and we've gone on to produce this all around the world, including Australia. And what we find is that, especially over the long term, it's very difficult to beat the benchmark. And we recently released our SPIVA Australia scorecard. We saw that 77% of Australian equity general funds underperformed the ASX 200. It was actually the second worst underperformance in our history, which was pretty interesting. So I would say that the SPIVA scorecards show that it's very difficult to beat the benchmark and to do so consistently.
Fascinating stuff. Anu Ganti, head of index investment strategy in the US from the S&P Dow Jones Indices, I guess the creator of indexes or indices that we know and a lot of the investment world uses. Thank you so much for your time and insights.
Absolutely. Thank you so much.